I mean, look at this thing. Tell me what the fastest horse is. You've got the dollar, gold, and Bitcoin all on the screen. And right when Scott Bessent basically said out loud, the time has come. I, my friend, am in a sovereign debt crisis. So, I mean, when guys like Ray Dalio running to the media and saying, sell your bonds, buy gold, and buy Bitcoin. Okay, I mean, what else do you want to know? Paul Tudor Jones disclosing in the 13As, I think, that he materially added to his Bitcoin position.
There is a moment when the market stops asking whether something is wrong and starts asking what survives when the problem can no longer be fixed the old-fashioned way. Right now, that moment may be unfolding in the U.S. bond market. Treasury yields surged, Washington stepped in with a dramatically larger bond buyback program, and almost immediately, Bitcoin accelerated higher. The Treasury doubled the maximum size of certain long-duration buybacks from $2 billion to at least $4 billion per operation, and Scott Bessent has already suggested the number could go even higher. If the government has to increasingly intervene when bond yields rise, investors eventually have to ask a very simple question: why own the asset whose price the government is trying to control? Gold can float, Bitcoin can float. But if Washington is effectively trying to put a ceiling on the cost of its own borrowing while the debt continues climbing, something else has to absorb the pressure. Strike CEO Jack Mallers believes that something is ultimately going to be the dollar and the capital fleeing it. This is precisely why many believe Bitcoin's recent surge could be about much more than another crypto rally. Bitcoin is ripping higher alongside gold, while the Treasury is fighting to keep the long end of the bond market from becoming even more expensive. Maller's argument is that this is only the beginning of a much larger repricing. If investors increasingly conclude that the U.S. government cannot simply allow the bond market to freely price the enormous amount of debt being issued, they have to look elsewhere. The question stops being will Bitcoin go up, and becomes how much capital eventually needs an asset that cannot be politically capped. Stay with me, because Maller's argument gets even more aggressive from here. And if you want more breakdowns like this, hit the like button, drop your take in the comments, and turn on post notifications so you don't miss the next video.
What about Warsh? You know, to me, it could be, we all know that Warsh and Bessent are buddies. We all know that they're disciples of Druckenmiller and that whole macro hedge fund crowd. And I mean, the Fed and the Treasury are going to need to act in tandem together to pull a lot of this off. I mean, basically, you know, we're building the plane while it's flying. The plane is on fire and they need to tame the fire a little bit and make sure that it doesn't burn in the air and find a way to land it. But the plane is like a wing of the plane is on fire, okay? And it's going to take the Fed and the Treasury acting together in this kind of era of fiscal dominance. And to me, I just found it peculiar and interesting that Bessent decided to really just start going nuts. Yo, I got $1 trillion in my bank. I'm ready to buy all the long end. He's telling all these reporters writing op-eds on him to go themselves. I mean, he's losing his mind. And it might be because he finally got a counterpart in the Fed that knows the plan and is willing to play ball, which is basically rates are not going to go up. Inflation is going to have to be persistent. And remember, we've talked about Warsh, who's been talking about inflation, but he's coming up with a new definition of it. I forget what it's called, but it's like his version of inflation. Not actually, but it's like some weird variant of inflation, which is wait, you're just redefining inflation. You're the chair of the Fed. You cannot just come up. You can't use this dormant at the bottom of the drawer definition of inflation. But my spidey senses, let me put it to you that way. My spidey senses are as such where I'm wait a minute. So Bessent got his buddy as the Fed chair. And shortly after he's been sworn in, Bessent's going full-blown nuclear, basically implying we're not going to be able to hike rates. Inflation is basically baked in. We're going to have to grow our way out of this, run it extremely hot. This is very, very weak dollar. Real rates are going to have to be negative. They're going to full send this thing. And is it because him and his buddy have a plan? And then you think, well, where's Bitcoin in that plan? It's interesting. Food for thought. So anyway, back to the point of this isn't yield curve control. It's not, because technically it's not, like according to the definition. But this chart from Luke, it effectively is, because so yield curve control would be, hey, the number is 4.9% and like that's it, and that's where that's not what is happening. But if you look at this chart, so the black line is at 4.7%. Every single time the 10-year yield gets to 4.7%, they do something. And all these green arrows, the red is the dollar. So every single time the 10-year gets to 4.7%, they whack the dollar down. And so, yes, it's not yield curve control technically, but it's basically because they're effectively saying the level is 4.7 to 4.8%. So, like I said, if I'm an investor, and this is what's happening around the world, who's buying Bitcoin, who's buying gold? If I'm an investor, and the U.S. government is saying, I'm not going to let the price of the thing go up past this level, then you guys, why the would I buy that? Why would I buy that? This is the power of something like Bitcoin or something like gold, is it is a floating free price. Think of Bitcoin as a zero yielding bond that can go up forever. Think of it that way. So what's Bitcoin pay you in yield? 0. But what's the cap on Bitcoin's price? Infinity. I'd rather own that. Okay, fine, you're paying me 4.7%, but inflation is a lot higher than that in all the things that I need in my life. And you're not going to let the thing go up to the price of inflation. Let's say inflation's 6, 7, 8, 9, 20% if I want housing. Okay, great. So I own something stuck at 4.7% while the rest of my life's getting 20% more expensive. Meanwhile, Bitcoin's paying me 0%, but it's up 25% over the last week. It's a zero yielding bond that can't be price controlled. That's what people want to own, your yield.
This is the heart of Maller's argument. The market is supposed to determine the price of capital, but when the price of capital becomes too painful for the government has an incentive to intervene. Mahler sees the repeated reaction around the 10-year yield as evidence that policymakers are increasingly unwilling to tolerate a completely free market repricing of U.S. debt. And once investors recognize that dynamic, the traditional bond versus Bitcoin calculation starts to look very different. But now take that one step further. What happens when the Treasury isn't merely trying to manage yields, but has to compete with some of the largest technology companies in the world for the same pool of long-term capital? That's where the second part of Mahler's thesis becomes even more interesting, because America's debt problem isn't developing in isolation. AI is creating an entirely new monster borrower at precisely the moment the U.S. government needs enormous amounts of capital itself.
So, again, from Bessent, Treasury Secretary Bessent will do whatever it takes to, quote, put the fear of God, end quote, into the bond vigilantes, shorting the long end of the curve in an attempt to drive the 10-year yield to 5%. Wall Street executives with direct knowledge of his thinking say that would include buybacks, selling short-term debt, possible elimination of long-dated bonds like the 20-year. It's a short-term solution to keep yields from soaring further, strangling growth as the midterms approach, they say, and doesn't address the real problem. The U.S.'s debt is now at $40 trillion, and competition for capital from the AI build-out. Longer term, don't look for austerity coming out of the Trump White House in its remaining years, they say. The plan remains top possibility to grow our way out of the debt level through increased tax revenues, because the cure for such high debt levels would be recession, inducing taxes, or austerity. Again, Bessent is saying what I've been saying. Are they going to go through austerity? Which, by the way, you want to own gold and Bitcoin in that version too. No, they're not. What are they going to do? Grow is another way of print. Grow is inflate. Listen, guys, let me put you this way. Let's say the U.S. economy is growing at 10% a year. Why would I own something that's paying me 4.7%? Why don't I just own the stock market? The economy's growing at 10%. That means the S&P 500 is going to be growing at something probably marginally higher than 10%. Why would I own something at 4.7%? This is what we call real rates negative. You pay people less than the growth you're producing. And guess what? Nobody's that stupid, at least not to the tune of lending them $2 trillion a year. $2 trillion of time, energy, effort, and labor is not that stupid. So they're going to go own something else. And by selling bonds and owning something else, that drives the yields up. And that's when these guys have to start printing money themselves to lend to themselves because no one's willing to lend to them. So this is the government's, this chart says a million words. The government is borrowing at crisis-size levels. It's outrageous, the amount of spend. And AI is competing with the Treasury. So, this is from Bloomberg. AI is driving up Treasury yields. It just touches everything. So these hyperscalers are issuing debt to finance data centers, power, chips, infrastructure. And the same investors that would lend to the government would rather lend to Elon Musk, to Google, to Zuckerberg, to Amazon. Like, it's just a no-brainer. And so it's becoming a lot more competitive. So this slide is the Treasury wants money, AI companies want money, infrastructure build-outs want money, and they're all competing against the same capital. So the market is saying, listen, this is, again, guys, it's just supply and demand. There's a lot of demand and there's not a lot of long-term capital. And so the long-term capital is saying, I'm going to raise the price. Hey, U.S. government and Elon and Google, how much are you willing to pay me for my money? Or how much duration are you willing to give me? And these AI companies are giving a better deal. And so people are like, why would I own a government security where they're interfering with the free market on how much it's going to be worth and how much they're willing to pay me? I don't want to own that. You'd have to, again, that's why this is such a big deal, what Bessent is saying. He's like, we're going to step in and we're going to start intervening. It's like, okay, well then I don't want to own any of that. Why would I ever own that? I'd rather lend to Elon. I'd rather own a T-bill than a 30-year. Or I'd rather own Bitcoin. That's it. So the market is very explicitly saying, pay me more. Pay me more. There are more people that need a loan. I'm the long-term capital. Pay me more. And AI businesses and others are willing to pay more. And the U.S. government is not. The U.S. government is saying, shit, I got 4.7% on the 10-year max. Anything more than that, you got me f***ed up. Okay? I'm just going to start printing money and giving it to myself. Well, then never mind. Let's all own gold. Let's all own Bitcoin. Let's all build AI. And these guys are insolvent. These guys are insolvent.
Mahlers is describing a competition for capital between the U.S. government, the AI revolution, corporations, infrastructure projects, and every other borrower demanding long-term money at the same time. The Treasury needs investors to keep financing an enormous debt load. AI companies are offering investors a completely different risk-reward proposition, and when the government tries to prevent its borrowing costs from rising too far, it risks making its own bonds less attractive relative to everything else. That is why the Treasury's recent intervention matters so much for Bitcoin. The initial buyback expansion helped ignite the latest move, but the bigger story is what the intervention tells investors about the constraints facing policymakers. Treasury has already doubled the size of certain long-duration buybacks, and Bessent has said future operations could exceed $4 billion. Meanwhile, the 30-year yield recently reached its highest level since 2007. While U.S. public debt crossed $40 trillion, these are not isolated numbers. They are signals of how difficult it is becoming to reconcile enormous fiscal borrowing with a bond market that still wants to be paid more for taking duration risk. A Treasury bond gives you a contractual yield, but policymakers can intervene in the market around it. Bitcoin gives you no yield, but there is no Treasury Department deciding that its price cannot rise above a certain level. There is no government committee determining how many Bitcoin can exist. There is no emergency buyback program capable of creating more Bitcoin when demand overwhelms supply. Demand can create more dollars. Demand can create more debt. Demand cannot create more Bitcoin. And that may be the real significance of this Bitcoin rally. The market isn't necessarily discovering Bitcoin because Bitcoin suddenly changed. The market may be discovering Bitcoin because the alternatives are starting to look increasingly constrained. Gold has already been signaling that investors are looking for protection outside traditional sovereign assets. Bitcoin is doing the same thing with one enormous difference. Its supply is absolutely scarce. Its price is globally determined, and nobody can simply announce a larger Bitcoin buyback to manufacture more of it. If you found this breakdown useful, smash the like button, subscribe to the channel, and share this video with someone who needs to see what's happening beneath the surface of the bond market. And I want to hear from you. Do you agree with Jack Mallers that the US is heading toward a world of fiscal dominance and negative real rates, and if that happens, is Bitcoin ultimately one of the biggest beneficiaries? Let me know in the comments. Thanks for watching, and I'll see you in the next one.